What is the difference between active and passive investment funds? Well, when it comes to choosing funds in which to invest, two primary strategies currently dominate the landscape: active and passive investing. And when selecting a fund, it's important to know the difference and understand what it means for your investment. So let's start with active funds. Active investment funds are characterized by a proactive approach where fund managers will actively manage their portfolios by selecting and regularly adjusting their investments. Active funds aim to outperform the market by making informed decisions based on research, analysis, and following market trends. Active fund managers continuously monitor their investments, buying and selling securities in pursuit of superior returns, and they may make frequent trading decisions to capitalize on market opportunities or to mitigate risks. But because of this, active funds often charge higher fees due to the research and transaction costs associated with such frequent trading, and these fees can eat into the overall returns over time. But proponents of active investing argue that skilled fund managers can generate above average returns by making strategic investment choices. However, active investing also carries the risk of underperforming the market, as not all active managers can consistently beat their benchmarks. In general, active investment funds are all trying to beat the average return of the market by making better choices than the rest. But the rest of the market includes all of the other active funds, so it's expected that just as many of them will underperform the market rather than overperform. Passive investment funds, on the other hand, follow a much more hands-off approach. Passive investment funds do not actively pick individual securities, but rather seek to replicate a particular benchmark, commonly a market index, such as the S&P 500. So whilst an active fund which uses the S&P 500 as a benchmark will seek to choose the best companies within the index to purchase and try and outperform the average return, a passive fund will just simply opt to buy everything in the S&P 500 to match the average return. Passive funds generally have much lower management fees as they require minimal research and decision making. In active funds, employing individuals to make key decisions and analyse the market can be the highest costs associated with the ongoing cost of running the fund. A passive investment style reduces the need for these skills and vastly reduces the costs associated. And this cost advantage can lead to higher net returns over the long term. Now, passive funds tend to hold their investments for the long term, and that approach can result in lower overall transaction costs, further reducing the costs associated. And because passive funds seek to match the performance of their chosen benchmark, investors should be prepared to accept the market's average return, both in years when the market's going up and unfortunately years when it's down. However, it is important to note that a passive fund's chosen method of replicating an index will impact its performance, however slightly, because on one hand, you could go for full replication, which involves buying and selling securities to exactly mirror the index that it is tracking. Whereas stratified sampling, on the other hand, will purchase a selection of securities which closely mirror the index. Stratified sampling will involve fewer trades, and as a result, it's cheaper, but it's less likely to mirror the performance of the index exactly when compared to full replication. And that difference is what we know as tracking error. Both active and passive investing strategies have their merits and drawbacks. Active funds seek to outperform the market through active decision making, but do face higher fees and the risk of underperformance. Passive funds, on the other hand, just aim to match the market performance while benefiting from lower costs. Now, the choice between the two approaches ultimately depends on your investment goals, risk tolerance, and belief in your ability to select active funds managers who are able to outperform the market fairly consistently. Many investors might also want to blend both strategies and take an approach known as core satellite investing, to strike a balance between active and passive management within their portfolios. And you can achieve this by buying both active and passive funds together, or even purchasing core satellite investment funds, which seek to offer the best of both worlds in one fund. If you're looking to get started with investing, now is the perfect time to organise a complimentary consultation with a Black Tower advisor. Black Tower has a footprint in many locations around the globe and will match you with an advisor regulated to give advice in your location. No two people are the same, so it's important that any financial recommendation is tailored to the individual. During the consultation, the advisor will learn about your unique circumstances, your attitude to risk, any ethical concerns you may have, and your long-term goals. Once the advisor understands what your long-term financial objectives are, they will design a plan that suits your circumstances to achieve those goals. To get started, click the link in the description and sign up today. So thanks for watching. Until next time, I've been Luke Staden, and this has been What is the Difference Between Active and Passive Funds?